I have been associated with the PMS Bazaar team from day one of the conference in 2018. And I must say that they have done a commendable job in educating investors and bringing transparency in the PMS and AIF industry. So great work done by you guys. And on behalf of this panel, I wish you the best for the fifth conference. So we're already having a shortage of time. So just the preamble to this conference, just glancing through the Hurun Wealth Rich List Report 2022, and I found some of the very interesting points which all of us must ponder upon. A record 735 entrepreneurs, the total list, out of that 67% are self-made. And out of the current year new list, 79% are self-made. So that's one part. Second, 65 founders came from the 37 unicorns, and 149 new entrants came from 32 different industries across 36 cities, which tells us that the wealth has gone beyond the metros. Third, 100 entrants came from the 65 startups. And what was, got my most attention, that the average age of the list 10 years back was 37 years, last year was 23 years, and this year is 19 years. So on one side, we are seeing the average wealth of the UHNI clients growing, and on the other side, we are seeing the average age shrinking. So this is a perfect debate to understand how is the wealth management industry, instantly on the left side, and asset management industry on the right side, adapting to this new gen UHNIs. So let me get started immediately with Nithin. Nithin, if I'm right, I heard in one of the interviews that your 90% of the clients are entrepreneurs. Yeah? So this new gen UHNIs, request you to give us a good flavor on how does this entrepreneurs, how does the UHNI think, what is their risk appetite? Just because they've created wealth out of their own business, do they think of capital preservation, or they just think of high risk, high growth?
So, firstly, we'll try and keep it short in the paucity of time. But I think even the new gen UHNI category can actually be divided into two. And they're two very different personas. One is about wealth being created in typical old businesses, smaller towns, second generation families, people coming to manage that. And the second is typically the startup community. And I think these are two segments that do think very differently. But at the end of it, if I actually just sift through all of the chaos, etc., that you see, I think what these guys have become very good at doing. One is about looking at value add and the return that can be delivered. So one is that risk appetite is higher. There's no doubt to it. Secondly, in the second category, where you're seeing a lot of startup-led entrepreneurs come in, they already have a large amount of their capital blocked in terms of venture capital and various other investments that they've made. And therefore, the typical conversation with wealth managers, paradoxically, at times can actually be about reducing risk, because they're already taking enough risk through their businesses. But I think, putting that aside, generally for new age UHNIs today, people are looking at value add within portfolios. They are looking at trying to see how to add more and more return, with, of course, the appropriate amount of risk. It's not about just only looking at trying to add as much risk in portfolios and not looking at capital preservation. So, interestingly, what you see happen in old business families, you're also tending to see with them, but with a much more enhanced level of, I would say, just understanding and being and decision making.
Coming to you, Atul, you have more than 2 decades of experience in domestic and international wealth management, both in US as well. So how have you seen the evolution of this UHNI then and now? And how has their approach to wealth creation changed?
So, I think the risk appetite obviously is high because they are younger, right? And they have a whole life ahead of them. They are much more confident that they can create wealth once, they can create it again. So they're not going into the wealth preservation mode. In terms of, how they look at wealth managers particularly, see, I think there are few capabilities that are far more critical to them than traditional ultra high net worth managers. I think digital is one thing. right? They need the service levels. They don't necessarily rely on the trusted, I mean, while a trusted advisor is needed in most cases, but the efficiency of relationship management is critical. They are thinking a lot more alternative investments. So, they're not sticking to, the next public stock or the next mutual fund, but a lot more alternatives. Private market in particular, because they have obviously had experience with that. When they get liquid cash, they still like to allocate a large chunk to that. Global investing, so they want to be global because most of them have either studied abroad or have a very global perspective on life. So a lot of them want to access opportunities globally and looking for that. So I think from a capability set perspective, all of those things are important. I think one of the other sort of aspect that is critical to them is solutioning. So when wealth managers look at them, they need to think solutioning. They are not asking this question, okay, tell me which stock to invest or which mutual fund to invest, but how do I optimize my taxes because they have had capital gains from the business sale, structuring their wealth. So, from, global structuring, local structuring, how do I really, what is the most efficient vehicle to manage my wealth? So a lot of those are questions that they ask, right? And that's why the wealth managers that are serving them need to be equipped with all of those capabilities.
Just before even you come to the asset management team, let's take a little dive deeper into the asset allocation trends. So when these clients come to you, what are their asset allocation patterns when they came to you? And what are your recommendations of the asset allocation?
So I think just taking on from what Atul said, I think clearly, so it depends, right? If you're talking about startup founders, typically most of their wealth is either parked away within the company, in which they may not have necessarily been able to take out that much money, or typically they've got a range of venture capital investments that they've made on their own through their own networks, etc. Right? And they've had a liquidity event through which they've taken out money. Taking on from what Atul said, they are still open to taking risks. So they understand private markets, they understand the value creation that can happen out of that. They're not necessarily looking for that money to be liquid immediately, right? So we still work in terms of trying to build out an overall portfolio for them. So I think the word solutioning or value add is very critical to them. They want to look at it from a portfolio-based approach, right? You would typically not tend to see the traditional patterns of saying you only have 10-15% of money parked towards private markets, a large amount towards public equity and fixed income. That trend is a little reversed. You will tend to see larger amounts going towards long-term alpha creation opportunities for them. So that's as far as the startup founders go. I think corollary even for old businesses where you've seen self-made entrepreneurs, and you see a lot of that in smaller cities actually. So I think answering the question that you're talking about, when you'll travel to any tier 2 city, starting from Nagpur to Kanpur to whatever, you're seeing a spate of millionaires getting created. Interestingly, most of the investments previously were the previous generation either made in real estate or made in, let's say, fixed income. These guys are now much more equipped to look at new emerging asset classes. So and especially what the last 2 years has done is it has actually completely accelerated what PMS and AIF Bazaar talks about, which is the whole alternative investment universe. So they're happy to look at ways of increasing alpha whilst looking at risk across everything, right? From hedge funds to looking at venture debt, venture capital, private equity, long short, the whole gamut.
And what percentage of their money is in alternates currently, approximately?
Ranges, but I would say rule of thumb anywhere from 20 to 30%.
Yeah. So that was for the asset management team to know. So Atul, just and for this new gen UHNIs, how do they think about the physical assets, the real estate, gold? How's that different?
So I think gold, I don't think finds favor with them. Real estate also as an investment, not. But this very interesting thing that all of these entrepreneurs, when they create significant capital gains, the only way to sort of optimize their taxes is to, through the 54F, make a very substantial real estate investment. So actually there is, it ends up being a large part of their portfolio, the physical real estate, but a lot of it is driven by the need to optimize taxes rather than their love for real estate as an investing class. And they actually end up living in that house as well. So I think, you see a lot of these 20, 30, 40, 50 crore apartments being sold in in South Mumbai, Central Mumbai. A lot of that is actually entrepreneurial money. But large motivation for that is 54F.
54F. And just that question for the asset management, what percentage of your clients' money is in alternates, approximately?
Yeah, I mean, maybe 20-25%, but I think it will likely be higher in the future.
Likely to be higher.
And yeah, I mean, the global investors that I have seen in the past, larger families, now that number is reaching 40-50%. Now, again, this includes all kind of alternatives, right? Yeah. So it's not just private market, but a lot of the hedge funds, money, the market neutral type investments, long shorts, etc. So I'm saying alternatives versus long only equities and long only bonds. Sure. So everything else is 40-50% globally. In India, for a lot of the new age investors, maybe 20-25%, but likely to increase.
No, I agree. I think if you look at the BCG asset management report that had come out previously, it talked about 30-35% of money being parked in alternatives globally. And I think at least for portfolios like ours, Atul's, etc., it is a similar number. The interesting part is, and if I just look at our own example over the course of the last year, I think in last year alone, the kind of throughput that we've seen across clients in terms of wanting, this has become a proper asset class in clients' mind. One is that pieces like hedge funds, long short, market neutral strategies actually have become part of core fixed income portfolios for clients. Fixed income is a very large asset class and people have started looking at it in that manner from saying that it's, you've got various sub-asset classes and how you allocate to it. The second is that, of course, private markets, of course, on the benefit of a lot of the FOMO in the markets, the way that they were over the course of the last year and a half. But that acceleration of the trend has happened. I mean, to give you an example, just for us alone, we did about 5,000 crores of throughput in just private market equity assets in the last 1 year.
1 year.
We did, yes, as compared, we did about 2,500-3,000 crores of private market fixed income assets. And this I'm not talking about long, short and other categories, right? And it's a similar trend across the industry. We are not unique in terms of that. So people are seeing it as a proper asset class. So be it new gen families or be it old UHNI families, the alternative investment asset class today is forming 20-25% of client portfolios because they can see the story of the long-term alpha creation in India, right? The trend of having to invest for the next 5 to 10 years to generate that, right? Happening clearly. So you're seeing a significantly higher domestic UHNI capital now start to come into these asset classes, like how it happened in public equities.
Perfect. Sorry to keep the asset management industry waiting, but I think we got to know that about 20-30% of the money are in alternates and growing. And I was amazed to see how Avendus has raised. And I think we all agree that it's important to align the product offerings with what the wealth management industry and the investor requires. Shahzad, you've been pioneer of the alternate management industry in the country. How have you seen the evolution of the alternates in the last decade?
Sure. Am I audible?
Yeah.
Great. Thanks for that and thanks for having me here. If you look at till about 2007-8, you could either do long only equity or you could do fixed income. Yeah. There was not much else you could do. But since then, and more so since the opening up of the AIF space, there has been an incredible growth. So you've got all sorts of asset classes, a lot of asset classes my colleagues spoke about. And firstly, you've got a lot more wealth created, all the numbers you spoke about, Nimesh, right? We've seen that grow, and we've seen it grow from all types of entrepreneurs, of course, traditional, non-traditional, rather the new age, etc. The industry has grown extremely well. When you look at it, the number of players you've had. So you've got everything from boutiques to larger asset managers like ourselves, like your own firm, Nimesh, which we've got out there. And you've got, you've got every single asset class, which is almost conceivable. So that's been a great, great start for the industry. A lot of the asset classes you spoke about, which are there. Our sense is it will only increase. And when you look at, I don't recollect the numbers precisely, but when I look at the growth of the alternate investment industry, you just peg that growth, the first 10 years of the alternate investment growth, and if you look at it, it's actually 2012 to 2022. It was incomplete in May of 2012 to 2022. The growth rate over the last 2 years in the alternate space has been significantly higher than what it has been in the mutual fund space. I don't recollect the numbers precisely, but it has been in an order of magnitude of 3 or 4 times. So that just shows how well the industry has picked up. The other proof of it is the number of participants, the nature of, the underlying asset classes, etc., which are there. So the growth has been splendid. It will only grow. I suspect, of course, as we iron out a few more things, let's say, especially on the tax, etc., and that's more so for long, short funds, etc., things would grow even faster, right? So that's something which we really look forward to, a very strong growth of the industry. I think we barely scratched the surface, and there's a lot of space for everybody. I'll just make one more point to, to what our colleagues on the wealth side spoke. See, a lot of where the assets are today, I think, is also a function of the market conditions and the mindset of investors. Yeah. So let me tell you what I mean by that. If I grew my wealth tremendously over the last few years, and my stock is sitting at an all-time high, either listed or unlisted, I would think very, very different, as different from if my stock is down 50 or 60%, right? And that, I think, is going to start showing going forward. Because don't get me wrong, it's not that I'm not positive on India. I'm very, very positive on the future of the country. But a lot of the places where there have been excesses, we've seen that moderate. And I suspect you'll see a lot more of that moderation, okay? So if my thesis is correct or reasonably accurate too, I think you might see some more move from some of the more aggressive asset classes to something more traditional, simply because when I'm not so sure of my future or less certain, maybe I'll be a little less aggressive. That's all, so.
Can't agree more, Shahzad. I think Nithin also was nodding from behind that. That looks real. So coming to you, Richard, I was talking to a few of the audiences, and they were not aware about TrueBeacon. So maybe you can, for the benefit of all, just a quick short introduction of TrueBeacon, and what are the needs of the UHNI clients you're trying to serve. That would be helpful for that.
First of all, point out, perhaps, you're looking at this foreigner on a stage and thinking, what on earth does he know about India? But I can assure you, although I am looking and sounding like a foreigner, I'm an Indian entrepreneur and I live in Bangalore, so I know the type of client that we're talking about reasonably well. Just about TrueBeacon. TrueBeacon is a sister company of Zerodha. We started manufacturing Cat3 AIFs 3 years ago. We've got a couple of onshore AIFs, one offshore in Gift City, and we've just recently started our own equity factor quant PMS, and we also do wealth management too. So we're a small team down in Bangalore, but we've got quite a few hundred clients in that type of category. I think stepping back a bit about what these characters want now, and I think when we were working together at Standard Chartered, I had a great privilege of getting to know many, many ultra high net worth individuals. And I think now we look at these young men and women, they're creating huge wealth, but they're doing it not sequentially as they used to. You'd have a business promoter family, get to my age, mid-50s, suddenly think about what are they going to do for the next generation, how are they going to give back to society, all these types of things. That has changed fundamentally, not just here in India, but around the world. Young men and women who start creating wealth now build wealth in parallel alongside their operating business. They do it from a very young age, and that wealth is not just about their own personal wealth, it is about doing a better job for the planet. It's about philanthropic endeavors, but it's also about experimentation in different asset classes. And I think that's really exciting. And one of the things we try to do at TrueBeacon is not just manage people's money, which is obviously incredibly important, but also create strategic value for them. And I think youth is very exciting. So I'm constantly, every single day that I'm living here, very excited about the human capital here in India. In fact, I think it's the biggest strength of this country and why I've been so excited about this place for so long. But actually, with youth comes the necessity to have people around you who perhaps do have a bit more experience, who do have different networks, different connectivity points. And if you can, as a company, and I'm sure we all do this, connect your clients to those types of opportunities, both in the private markets, public markets, I think it's quite compelling.
Thank you, Richard. I must say, you don't look mid-50 for sure. Yeah.
Thank you. Best compliment I've had all day. In fact, the only compliment I've had all day. But anyway.
Continuing with that, Richard, you have the global experience. So would you be able to compare or share that what are the kind of asset classes or product offerings which has large AUMs in globally, but not present in India? So that's a great opportunity. What kind of products?
Yeah, it was a very good point that you were making. I'm constantly astounded. I think I'm right in saying the first hedge fund was formed in the US in 1965, and here, obviously, analogous product was 2012. So I think that I'd pick up on a couple of points I referenced earlier on. It's undoubtedly about sustainability. It's about carbon. It is not a mature market anywhere in the world yet, and it certainly isn't here in India. I think as time goes on, I think investors, whether they are frankly retail, whether they're ultra high net worth, whether they're consumers, everyone, I'm the proud owner of 3 teenage kids, and I'm sure all of us on the panel, that youth I spoke about, they are truly passionate about the planet, and rightly so. And that will become a really huge area of focus. Now, whether that happens in 3 years, 5 years, 10 years, I don't know. But that's the way the world is going to go, because it has to go that way. So I'd say that is the trajectory.
Interesting. Shahzad, I was looking at your offerings deck, and what I found interesting was that you launched a digital innovation AIF. Is it got to address this sophisticated investor need, or what's the premise behind launching that product?
Okay. The Digital Innovation Fund is actually an early stage startup fund. That's Series A. It is seed and Series A primarily. It is catering to, initially, the first round was catering to global investors. So we had a set of Japanese investors, that's the country of my parent, and typically institutions, and a lot of the, let's call it, introducing a lot of the innovation. That has 2 legs, and that's interesting, and that should make a lot of Indians proud. So other than the financials benefits we would get, or the investors would obviously get, there is also a lot of, let's put it this way, the learnings and the transfer, etc., of, let's call it, for the lack of any other word, I would use it, the transfer of, understanding of the digital ecosystem in India, which is much appreciated by a lot of the world. So large Japanese corporates, and we have 7 large investors, typically Fortune 500 investors in that, Fortune 500 companies in that. So there's a lot of learning on that front. But, based on that, we should be launching another fund very shortly in the early stage. And, we'd rather focus on the early stage because I know that's not the topic of discussion, but there's probably less froth in the early stage than in the latter stage of investments, in the late stage investments. But that's where we are.
Interesting. Thank you. This is open question. Maybe I'll lean toward the left. I believe the new gen UHNIs are technological savvy, well connected, socially active. So how does your team, serve them digitally? Are the client engagements completely moved digital, or they're part physical digital? And have your firms invested into technology, and how can improve the customer experience?
So, digital is part of the experience. So I don't think any client is looking for digital only, but they need optionality to look at their portfolio, maybe do a few things on their portfolio, check out products, etc., when they want, right? So that option they want to retain. But of course, the need for an advisor is quintessential. That remains. So yeah, you can call it a hybrid model, but both the advisor and the digital has to work seamlessly for ultra high net worth. The new age investors to be happy.
So just
I think, I agree. And I think also a lot of the investments that most traditional wealth managers like us are making, one is of course, in terms of really shaping the back office and transaction platform. And I think the second one, which whilst you're seeing some disruption in the space with, a few startups coming up who want to serve the new age UHNI segment, but I think there's a lot of demand for, as Atul said, about a reporting platform and about you being able to access it wherever that you want, have maybe an insight of reaching out, etc. But nothing replaces the fund manager. The wealth manager. So for us, again, our investment is happening in terms of looking at the client workbench in a manner where we are able to do all of this. Will this change in the next few years? I think it will. I think there will be much more of a digital push, but I think we've seen this globally now as well, that in this space, the trust element, the element of talking to a wealth manager directly is something that's not easily replaceable. And I think therefore that hybrid will continue to happen.
Can't agree more. Sorry.
And just in congruence to the asset allocation that we talk about, right? that, they need global investments, they need alternatives, they need private market, let's say a subset of that, etc. The digital strategy has to comply to that as well, right? So the old stage, old kind of, the booking systems did not have ability to really capture, private markets very well, or global, of course, there was no multi-currency. So now that's a need as well. So, you can't tell them that, look, we'll show you a view of your stocks, bonds, mutual funds, but, by the way, these 5 things are out of the view, right? That won't work. So you need a very, very strong digital backbone that is very flexible, that is all-encompassing, but it's there for them to use when they want it, but not replacing the advice.
Right? I can't agree more with both Nithin what he said, because trust can be built when in person. You can't really build the entire trust digitally. Once you know a client, and then maybe the trust is built, you can adapt to digital. But otherwise, I think very critical. So it's not one, but digital, which continue. Shahzad, you want to add something?
Yeah, I just wanted to state the following, that our sense is, as an asset manager, that addresses the digital part is for a lot of the operational matters. So that makes the, the hygiene and the operational aspects easier. The important thing is, my sense is that as an investment manager, a lot of the HNI clients really love to engage with the manager, because they're really keen to hear the manager's views. And truth be said, I would be very keen to engage with them, and I'm sure, Richard and team too, simply because those guys are so knowledgeable. Invariably, in many areas, they even know a lot more than us. So it's a learning for us, it's both ways, and, it's engagement which builds trust and the relationship. The digital part is more the operational side, to my mind at least.
Sure, got it. This is my last question, and again, it's open for all. So a lot of UHNIs prefer to manage money on their own through their family offices. Yeah? So what would be the advice of the wealth management firm and asset management firm to those family office or do-it-yourself clients?
So I think you're right. A lot of UHNIs have set up their own family offices. They're becoming much more institutionalized. I think they see the role of select wealth managers as actually value-added partners. And that value-added partners comes from 2 pieces. One is in terms of access to interesting opportunities that you're tending to see. Second is in terms of being a partner in terms of an exchange on views and really being able to add to knowledge. So typically, so it is almost a quasi-institutional relationship in a lot of these places. But I think it typically still rests upon these two pillars, which is about the fact that is the wealth manager who's coming being able to add value in that half an hour, 1 hour meeting in terms of either an understanding and giving in, on what's happening and what are the trends to look out for. And second is in terms of interesting and unique ideas within the portfolio, right, which they believe could add value.
So, the unfortunate part is that in India, barring maybe few very evolved family offices, rest of the family offices have not really defined their role as, with the investment acumen and asset allocation. They unfortunately have defined their role as sort of cost cutting, right? So all of them are focused on solving for cost, wrongly. They think that they have solved for advice, now they have to solve for cost. But that's a wrong notion. So, and the quality of talent that there is, it's not easy to get that quality of talent in your family office that really, truly does not need external advice and can do asset allocation, etc. And it creates some value destruction in the end, right? Because when you arbitrage too much on, which product can be and make decisions based on, what's the fees of the product is, you actually make suboptimal decisions, right? So I think this family office is a highly kind of misused, sort of misguided architecture. It will evolve, of course. Like I said, there are some very evolved family offices who really have invested in, for example, when you hire a family office manager, how are you going to pay them? Are you offering them carry based on the returns that they generate? All of those are very evolved concepts offshore, but not so much in India, right?
And I hope they evolve. So I was coming to the asset management side only. What is your advice? Because wealth management clearly says.
I can't agree more with these gentlemen, and because on a very serious note, setting up a family office, serious family office, and to my mind, and maybe I am ill-informed, but there is only one, let's say, old tech czar or a very, very rich family out of Bangalore who has a serious family office where they've actually created something like an investment management company. They probably invested more than an investment management company and have got good professionals across listed, public, unlisted, all sorts of spaces, right? That costs a lot of money. And I completely agree, because it's not about cost. It's a serious amount of investment you need to make. First, I think you need a serious amount of size to get that going. That's point number one. Else, it's like, a bit of an apology for a family office, which you do, because karna hai to, I need to do that. So that's point number one. Point number two, I'll again go back to what I'd say. The last sometime has been a bit of a fairy tale run for everybody. Very easy to make money. And when things are very easy to make money, everybody's an expert, right? So a lot of that changes, and that perspective changes a lot when things aren't going so well. We haven't seen that part yet, but maybe when we do, maybe people will have a little slightly different look at the family.
Yeah, I would love to disagree, but I can't, I'm afraid, because I think you're right. I think that if you look globally and here in India as well, even if you're a triple-digit billionaire, all of these characters have very sophisticated family offices, but they're not a replacement for any one of us here or any of our competitors, and neither should they, for some of the reasons which you articulate really well. Why would you create enormous wealth and then have your investment outfit shrunk? Even if you hire the best and the brightest from around the world, with all due respect, that is going to not give them the global reach and the access to human capital that can advance the family office. So I don't see them, there is this big misconception about it's a replacement for wealth managers, asset managers, and so on. They're not. Good family offices, in my experience, are relatively, either they're very disciplined about what they do and what they don't do, or they're relatively small. And many family offices around the world handling double digits in billions have a handful of people doing it. But they don't do it on their own. They use characters like us.
Interesting to see different perspectives, but maybe I am an old generation investor, not by age, but maybe by experience. And I believe that I would agree with what Nithin, Atul and Shahzad said. Maybe leave it to the professionals. There's wealth management industry. There are a lot of efforts in creating a wealth management firm, in developing products, in training the people. And getting up to the mark, I would believe that leaving to the wealth management experts and also the asset management experts would be the advice or the suggestion from this panel. And on that note, I would like to see Pallav and Daniel smile, so we'll end that present panel here. Thank you all.